Thank you, Ivan. That's quite an introduction. I should probably apologise at the start for what you're about to hear. I just thought to myself, the last thing people at a property conference want to hear are things like stagflation, higher yield curves, recession. But those are the kind of words which, unfortunately, I have to use far more than I would like this morning. And I suppose if there's one kind of positive message, I did struggle to sort of think about one, but hopefully we can maybe say that the worst is behind us, but there's certainly a lot more challenges to come over the next couple of quarters and into 2023. So apologies if you can't see this. You're going to get a free eye test this morning with some of my charts. But in terms of the overall outlook, effectively the consensus at the moment is that both the United Kingdom and the euro area are already in recession. And I suppose when we started the year, we were kind of a little bit cautiously optimistic that, despite higher interest rates from central banks and high inflation, or the pickup in inflation, that, maybe we could just about get through those kind of shocks. But what seems to have really kind of turned the picture, particularly in Europe, is obviously the war in Ukraine. And in particular, during the summer when the Nord Stream pipeline was shut down, we saw that big surge in gas prices. And with that, not just the translation into higher inflation, but also the fact that consumer and business confidence really got hit very, very sharply. So if you look at the PMI surveys out this morning for Europe, for example, you'll see, investor confidence, investment intentions, employment intentions have really fallen off in Europe. And effectively, it looks as if Europe is in recession as we speak right now. In the United States, it's a much more interesting debate. The hard data in terms of GDP, employment in particular, but also retail sales and consumer spending have actually strengthened of late. And I suppose the debate in the United States, will we see recession over the next couple of quarters as companies respond to the Federal Reserve raising rates to around, say, 5%. Things like the housing market in particular in the United States going to contraction mode because of the really big pickup in interest rates and mortgage rates there. And I think opinion is a little bit split. Maybe, some people saying we'll see a soft recession or maybe we'll just about avoid it, but you can see again a kind of a slowdown expected in the United States next year because of what the Federal Reserve are doing. There won't be many light moments in this presentation, so we should just take one and not quite laugh, but take account of the situation in the United Kingdom at the moment. Very similar to Europe, where inflation has eaten into real incomes and that's hurting consumer spending. But in the UK, we've had the fiasco of the mini budget and the increase in interest rates there. So I used to work in London for 8 years. I have friends of mine who live kind of an hour outside of London, commuting every day. And I mean, they are extraordinarily concerned that they have a mortgage of maybe 1-2%, and they're looking at mortgage interest rates around 6% in the UK at the moment. So that's a level of interest rates which hopefully will come back. But the UK housing market can simply not take mortgage rates at 6%. And, something has to give, and for the moment it's house prices. And if you saw the news this morning, the nationwide house price index in the UK was down 1.4% in November, following a 0.9% fall in October. And again, if you look at sort of sales rates coming from the home builders in the UK, or what Zoopla reported earlier this week, it looks as if new buyer inquiries are down sort of 45-50%. So effectively, the UK housing market has burst, and that's added an extra dynamic into the UK situation. So again, you can see here, UK expected to be one of the weakest economies, have the highest inflation. Of course, what's going on in the background with the UK is Brexit. It's the lack of migration that's making the labour market problems worse, making those supply chain problems, which everyone has felt, worse in the UK. So the UK a particularly poor case. If we take a bit more of an optimistic view looking into 2023, it does look as if the peak of inflation is maybe behind us, particularly in the United States, but you saw the number for the euro area yesterday at 10%, starting to come down. Gas prices have come back, and some of the more optimistic forecasts for next year would sort of envisage that inflation may come back a little bit faster than perhaps people are expecting because of what's happened to energy prices, but also because some tentative signs that some of those supply chain issues are starting to resolve themselves, in particular China. Now, there was a moment last week where markets fell back because they saw the protests in China. I suppose people felt that added to the uncertainty around the reopening of China. The zero COVID policy, I've seen some estimates that it might be actually reducing Chinese GDP by 4%. If at some point in 2023 China can reopen, that not just adds to Chinese GDP, but it helps resolve those supply chain issues that have been adding to inflation over the past 12, 18 months. So, a big uncertainty is that zero COVID policy in China. But again, some of the latest numbers coming through, some of the surveys suggesting that input cost inflation for manufacturers is starting to fall back now. Some of the kind of supply chain issues for manufacturers across Europe starting to dissipate, and some of that's natural due to the slowdown in the economy. But again, some fledgling signs, you want to be a little bit more optimistic that inflation is coming back, and we're kind of at peak inflation. The really big hit to households' real incomes is right now. So you're going to see those falls in consumer spending through Q4, Q1, but maybe later in 2023, in the second half of the year, real incomes can recover, and we can maybe see a little bit more of recovery. But look, it's a pretty grim outlook for the economy, and very, very hard for me to kind of dress it up any other way. In terms of central bank themselves, which should be to the forefront of anyone who's investing in property at the moment, a lot of tough talk from central banks across Europe, the Federal Reserve, the Bank of England, and there's a couple of months ago there's talk of even a dovish pivot from the Federal Reserve, and Jay Powell poured cold water on that and said, actually, if anything, we'll have to raise rates even higher than we previously indicated. And you can see here the curve, so on the left-hand side of showing you where rates are. The Fed at 3.75 to 4%, the Bank of England at 3%, and the ECB's deposit rate at 1.5%, and then what the market is expecting over the next 18 months. And you can see they expect a peak from the ECB around 3%, 4.5% for the Bank of England, and getting up towards 5% for the Federal Reserve. And these kind of big rate increases are likely to come through in sort of December, January, February over the next couple of meetings. So certainly more bad news priced in. But having said that, if you look at yield curves, the long end, 10-year yields, you can see that they've picked up, certainly, but just over the past couple of weeks and months, they started to come back a little bit. So we're firmly in inversion territory here. The yield curve is actually sloping downwards, which classically has been seen as a sign of a coming recession. But effectively, the bond market thinks the economy can't really take the extent of the tightening that's in there. To some extent, the Federal Reserve, the ECB, and others may raise rates to these levels, but then they'll have to cut them back again over the next couple of years. So in terms of long-term yields, it's possible that we are through most of the bad news. This yield curve inversion will continue. But having said that, we're talking about another 50 basis points potentially from the Federal Reserve in just a couple of weeks, 50 basis points from the ECB in December. We may well see further upside in terms of yields increasing at the long end as well. So that's the debate. Hopefully most of the bad news in terms of funding costs at the long end have been realised, but far from over, and I think it's pretty much a done deal that central banks will be raising quite substantially in the next couple of months, but then maybe we'll start to see more of this debate around the pace of tightening easing off a little bit more going forward. In terms of inflation itself, can it come back? You can see the headline rates here have picked up to double-digit levels. Of course, energy, oil prices, gas have made a big contribution there. And I suppose the good news is that oil prices back kind of $85 per barrel, so they've provided some good news. Wholesale gas prices, last time we looked yesterday in Europe at lunchtime, were €145 per megawatt hour. So that's down a lot from kind of levels above 300 around August when the pipeline was shut down, the Nord Stream pipeline. But of course, we've had a mild winter that's helped add to storage capacity in Europe in terms of gas. If we have a cold winter next year and the Ukraine war is still there, if Russian imports are still impaired, it's quite possible that gas prices might go up again. So, but you can see that there's been a massive positive energy contribution to inflation, which is unlikely to be repeated, and certainly inflation is likely to come down. Having said that, if you look at core inflation, 5% in the euro area, similar numbers in the UK and the US, it has been persistently higher. The whole argument that inflation might be temporary has certainly taken a bit of a beating this year. Even the more dovish members of the ECB, like Philip Lane and Christine Lagarde, have had to change their tune. And I suppose that people have realised that the supply chain issues have been a bit more persistent. And then you look at labour markets, and Ireland is not one of these countries. We actually have the exception. But particularly in the UK and the United States, very, very low participation rates. Part of that, that's most pronounced in older age groups, people not participating in the labour force, adding to labour shortages. Also in the UK's case, migration is an issue, so massive labour shortages, and you're seeing wage growth pick up to kind of levels of 5-6% in the UK and US. Europe has been a bit of an exception. Wage growth is a bit more muted. You can see core inflation is a bit more muted. So it is all about energy in Europe. well, not all about energy, but it's a much bigger part of the inflation story. So hopefully going forward over the next 12 months, with the energy contribution going away and core inflation being a bit weaker in Europe, that means the ECB has to hike less. May we see less upward pressure on funding costs in Europe over the next 12 months. I suppose just to give you a stand back from it all, though, this sort of gives you a history of the United States since the 1970s, and clearly the 1970s were a very difficult period. Inflation was kind of very high, unemployment was high. That was real stagflation. Then in the 1990s, had this sort of great moderation, weaker inflation, as central bank inflation targeting was implemented. And I suppose I spent the early part of my career in the early 2000s sort of saying, well, why is inflation so weak when GDP growth is so strong and unemployment is low? And of course, there's this whole debate around the integration of the Chinese economy and low imported goods prices holding down inflation into 2000s. And then after the financial crisis, we've had what was really the most exceptional period, extremely low rates, extremely low inflation. And I fear that many people in bond markets and in equity markets have become too accustomed to that. And we really need to think of the last 10 years as the exception, not something we're going to return to. So while inflation may come back from current double-digit levels, we're probably not going to go back to the levels below 2% that we saw over the past 10 years. So that means higher yields, means higher interest rates. Investment projects going forward are going to have to justify a higher nominal return. In Davy, as you mentioned, we managed 20 billion of assets or so. So it's been an extremely difficult year when you've seen what happens to equity markets, but also bonds. So typically you try to diversify, and that helps you through these difficult times. But unfortunately, with stagflation and interest rates increasing despite the slowdown in the economy and all of the pressure on margins for companies, you're seeing equities fall. This is a little bit like the 1970s when stagflation was a problem then. Interest rates increased, so there's nowhere to hide. And you can see that the fall off in equity prices has been quite severe compared to previous tightening cycles by the Federal Reserve. Bonds obviously down very, very sharply, and a worse year for bonds than in any of the previous decades we've looked at here. So we've kind of picked the worst year for bonds compared to this year, and we're well down. I suppose this is to some extent inevitable given quantitative easing and kind of compressed liquidity premia, term premia, the flatness of the curve. As interest rates have increased, we've had an absolutely terrible year for bonds, which unfortunately for many of you in this industry, looking at property assets has been extremely bad news. So I've looked at the listed real estate sector in Europe here versus the Eurostoxx 600, and you can see that it's underperformed extraordinarily versus the overall market, given property assets are effectively a bond proxy in many ways, and you have this added uncertainty of the economy. And in particular, the private rented sector, where yields have been very compressed, doing particularly badly, where cap rates were very, very low. I suppose what this says to you is that there's clearly a process of price discovery going on across real estate markets in Europe. It's happening here. If yields are going to be higher over the medium term, we have to sort of ask and try to pin people down. I see John McCarthy in front of me here, and perhaps he can tell us in the next panel session where yields in Ireland have to go. But if you think of a 10-year German bond yield at 2%, there are residential PRS yields net yields below 2% in Berlin. That clearly doesn't make sense anymore, so there's going to have to be quite a significant adjustment. And then you get into viability. So, we'll talk about apartment development later, but in stagflation, you have build costs going up because of the supply shocks. You have central banks raising rates to choke off inflation, and means that investment needs to justify a higher yield. And unfortunately, that has come through falling capital values. Viability gets squeezed. So it just sort of shows just what a pernicious problem stagflation is, and when central banks have to deal with it, that it makes life particularly difficult in terms of residential and property investment. Turning to Ireland, here's our forecasts. We'll have to revise these. GDP is out at 11 a.m. this morning, so I'll be almost wrong in real time. But I suppose the broad thesis we'd kind of gone with is that, yes, the consumer is going to be under pressure. There's a lot of inflation in the system. That's going to put consumers under pressure. Probably see falls in consumer spending through the turn of the year in a similar fashion to other countries. But as in the pandemic, our export sector should provide the economy with a bit of protection. If you look at this next chart, this is export growth, and I've sort of compared it to world demand. What's very striking is that also in the financial crisis in 2008, 2009, again during the pandemic, you saw these double-digit falls in global trade, but you didn't see similar declines in Irish export performance. So when you think of our export sector, it's pharmaceuticals, it's the medical technology sector, it's the tech sector. These are less cyclical or on their own trend, if you like, and that provide the economy with a lot of protection, which we saw in the labour market and the public finances during the pandemic. And I think speaking to international investors, they've kind of accepted that. Now, there's a PMI survey out this morning for manufacturing that looks a little less optimistic, but in the main, Ireland does not have things like heavy engineering companies, car production, for example, the really sort of cyclical sectors which are depressing activity in Germany, for example, at the moment. So I think, as in the pandemic, we should see some protection. How much is debatable, and we'll see, and it will evolve as a story over the next 12 months. But Ireland is a country, given the nature of its export sector, which should weather the current global recession reasonably well. The tech sector is very important for many of you looking at occupier markets, for the office market. It now accounts for 70% of Irish GDP, so a very substantial amount, about 30% of exports. And of course, we've seen the announcements of job cuts in the technology sector. And whilst the job cuts so far are reasonably small and peanuts really in terms of their overall size, I suppose the fear is that it sort of heralds a much broader downturn in the ICT sector overall that could hit GDP growth and certainly demand for offices in Dublin. Now, we're not experts on the tech sector by any means, so I think the best we can do is look at the kind of consensus forecasts for earnings per share and revenues at a group level for these tech companies. And you can see in the main, they are still reasonably positive for 2023 in positive territory. When we think of the job cuts that have been announced in, say, Facebook, Twitter, I think there's kind of very specific company issues there. They're kind of driving a lot of those. TikTok has gained market share at Twitter's expense, and that's expanding employment. And of course, there was a very, very aggressive hiring phase in the ICT sector, which maybe to some extent in the most aggressive hires, the big household names like Google, has to unwind a little bit. But look, there's no doubt that Ireland is exposed to the ICT sector. It could have an outsized impact on us. If there's a really severe downturn, I might be here in 12 months' time saying, well, even though GDP growth is negative, underlying conditions are a little bit more positive than that. In the same way that the ICT sector has kind of inflated the GDP figures, it could potentially have an outsized negative impact as well. Just on the consumer, we expect two quite aggressive falls in consumer spending through Q4 and Q1. Inflation has gone up to 9% as in October the energy price companies announced their price increases. So the average household energy bill is now around €4,000. People haven't received those bills yet, but they're up extremely sharply from last year, from around sort of €2,000. So it's a hell of a change. Obviously, the budget will help, but again, you can see that we effectively have flat consumer spending out to the middle of next year. Falls in Q4, Q1, a little bit of recovery in Q2, Q3. So consumers will be under pressure. And I suppose it's perhaps not realised that on this chart we're showing you that household income is actually up almost 20% pre-pandemic, whereas consumer spending is pretty much broadly flat. So we've actually been living with this squeeze on consumer spending for some time. Household incomes have been under pressure already, given the inflation that's already been in the system. And despite that, we've grown. So I think we will see a squeezed consumer, whether that actually sort of pushes GDP growth into negative territory for such an open, export-orientated economy, less clear-cut. These are just very quickly some of the measures. I mean, we need to contrast ourselves with the UK, where there's tax increases going through, where they have a very substantial deficit. Ireland is not in that position. We have a surplus. Of course, we know it's largely related to corporation taxes, and that they could be potentially volatile and unsteady. But the government is, for now, in a position to help households. And you can see some of the measures here: the €600 electricity price credit, the tax cuts next year. These will help household incomes and help kind of soften the blow. You are seeing many similar measures like this across Europe, but at least we're in a position where we're running a surplus. And I think if we're betting today, we'd expect many of these measures perhaps to be repeated next year if energy prices are still high and household energy bills are an issue. So I always worry about the fiscal situation. I think the government should be more conservative, but for the moment there certainly is quite a lot in the pipeline to help households. Just turning last to the housing market. I mean, in the UK, people are expecting house prices to fall 5-10%. Now, why are we different? Well, first of all, the ECB is only likely to raise rates to around 3%, the Bank of England 4.5%. We think the banks will probably only partially pass through some of that increase in the ECB rates. So if you look at the average mortgage rate in Ireland at the moment, it's around 2.6, 2.7%. We think it'll probably get to around 4% if the ECB does follow through. What this table does, if you can read it, it says, well, if rates do get to that level, are debt service ratios and affordability for the average first-time buyer going to be stretched? And the answer is no. We would have had 4% interest rates in 2016. So I think we can deal with that. So what's probably a little bit more concerning is that if we look at house prices relative to average incomes in Ireland, they are now similar to UK levels, back at kind of where they were in 2009. I think, talking to many estate agents, they do feel that sort of an element of overvaluation has crept into the market. That will probably unwind over the next 6 months to some extent. So we may well see house price falls up until, I'd say, March or so, certainly through the winter. Having said that, the central bank in its wisdom has decided to ease the mortgage lending rules. And I think that will help viability in the short term, but is ultimately inflationary. And I suppose it depends on the extent and speed with which first-time buyers go to the bank and say, rather than borrow 3.5, or borrow 4 times. As well as that, we have the equity loan scheme, the first home scheme. The name keeps changing on that particular scheme. The 20% equity loan, effectively a carbon copy of the UK Help to Buy scheme. So you can get your 4 times loan to income multiple, and on top of that, a 20% equity loan from the government. So again, we've seen housing starts to fall back. Our forecast have been for 27,000 units in 2023. And of course, we've seen the same reports about viability, and it's very hard to quantify that from residential developers. But when you have that increase in the mortgage lending rules and the equity loan scheme coming on stream, I think there's enough housing starts this year to probably deliver that 27,000 next year. And then you've got a lot of ammunition in the system to kind of increase house prices, particularly for new build, and sort of address some of those viability issues from build costs for houses in particular. Now, for apartments, I think there's a big issue, which we'll probably come to later on this morning, where obviously yields have gone up. That's squeezing viability into apartment development. And when we look forward to 2024, we might well see the level of apartment development we see at the moment start to fall away, and that could certainly hinder the response of the construction sector. But I think for now, we're probably reasonably confident we can get to 27,000 next year. There's certainly people who disagree with me. I'd say if you look at what the construction sector itself has forecast in the past, it tends to underpredict the overall level of output in a pretty consistent way. And of course, having said that, 27,000 units is certainly not going to come anywhere near to solving the massive pent-up demand and frustrated demand that's out there in the housing market overall. So I'll stop there from having run 5 minutes over time. I thought I should probably leave you with a positive message. I don't know if you'll take 2 negative messages instead. But I think overall, look, the one positive thing we can take is that the recession in Europe and the UK, the squeeze consumers is happening now. And hopefully as we go into 2023, the increase in gas prices and oil prices is unlikely to be repeated. If anything, it's gone into reverse to some extent. Inflation will come down. Perhaps central banks won't get quite as high as they're suggesting at the moment in terms of raising interest rates, and long-term yields are kind of capping out for now, may not increase that much further. So perhaps most of the bad news is out of the way. And as we get through Christmas, we might get a slightly brighter outlook looking forward into next year. So thank you for listening this morning, and hopefully I'll speak to some of you after the event. Thank you.